Hello everyone, welcome back to the channel. Recently, my eldest daughter took 3 exams that let her do some financial advisory work. She passed all of them and proudly told me that she's now certified. So I said, great. Then tell me about Markowitz's modern portfolio theory, the one that won the Nobel Prize in econs. She just looked at me blankly. I couldn't help laughing because I just pulled the same trick I read about in one of the first investment books that I ever bought, The Four Pillars of Investing. And just like the author, William J. Bernstein, he actually said that most financial advisors can quote the name, but cannot really explain what modern portfolio is all about. Now, that little exchange reminded me how often we repeat ideas and words we half understand, and it got me thinking. After all these years reading about efficient frontiers and risk curves, how much of that elegant theory truly fits the realities of retirement here in Singapore, especially once you bring CPF into the picture? Stick around, the answer might just surprise you. The first time I saw that famous graph that captures the essence of modern portfolio theory, I was totally fascinated. We always hear the old saying, high risk, high return, low risk, lower return. But this Nobel Prize winning theory actually turned that idea on its head. The x-axis actually shows risk and the y-axis shows return. And that curve up and to the left actually shows something remarkable, that it is possible to earn higher returns with lower risk. Now, that sweet spot where you get the most return for the least risk is what they call the efficient frontier. In theory, you mix different asset classes that don't move together, what economists call negative correlation. You, for example, add a few or add some equities for growth, bonds for lower volatility and stability, and you keep a stash of cash for emergencies, liquidity, and boom, you are diversified and ready to harness that efficient frontier. In Bernstein's book, he showed that the more asset classes you add, the more you tweak their allocation, the better the results you get, like magic. Higher returns with lower volatility. So that's actually how I got started in 2006 and 2007. And like most new investors, chasing that magical asset allocation. Over the years, I tried all sorts of strategies, chasing different risk premiums like value, small cap, even emerging market tilts, always hoping to squeeze a bit more return out of the same dollar. I also dabbled in dividend portfolios, every Singaporean investor's favorite pastime, thinking I was taking a defensive position. ComfortDelGro, StarHub, SMRT, SingPost, SPH. How? Diverse enough? Also, I thought. Mark Twain once said, and I paraphrase, the real trouble isn't what we don't know. It is what we are so sure of that turns out differently. And by now, I'm sure all of you realize that those defensive counters that I just rattled off weren't as strong as I believed. And when they tanked, some just never came back. That's why so many people can make a living writing and now talking on YouTube about investing every single day. It's great if you enjoy the entertainment, but as a retiree, I'd rather be financially free in the most literal sense. Let my money work for me and not the other way around. If the portfolio or strategy need looking after, sorry, not for me. The other turning point came when I discovered the 1M65 movement. That was when I started thinking seriously about how CPF could and should be part of my overall portfolio strategy. In one of my earlier videos where I shared our asset allocation, someone left a comment expressing concern about my two-third allocation, roughly about $2 million, in the MSCI World Index. He asked whether I had considered adding income or bond funds. Well, I did try. Earlier, I mentioned picking a dividend portfolio, which I later abandoned. And yes, I also tried an income fund, VHYD, a passive ETF listed on the LSE. I'll probably share that experience in a separate video, maybe later down the road. But the traditional income component in the 60-40 allocation is bonds, and that's the asset class that I will talk about in this video. First, bonds aren't always negatively correlated with stocks. We all saw it in 2022. Both stocks and bonds fell together. So instead of moving in opposite directions, the two became positively correlated. Second, the yields aren't fantastic either. Our own Singapore Government Securities (SGS) tells the story. At the end of October, when I checked, the 10-year yield was below 2%, and the 50-year was 2.25%, both lower than the CPF-OA floor rate of 2.5%. I took a quick look at the fact sheet of ABF Singapore Bond Index Fund. The ticker is A35, which I still have some units invested. The inception was 2005, so we are literally looking at 20 years track record. Guess what? The annualized return was 2.5%, same as CPF-OA. So for us Singaporeans, the closest thing to a risk-free income-generating asset class might actually be the CPF-OA. It's capital guaranteed, pays 2.5%, and you can withdraw it anytime. No mark-to-market shocks, no capital loss, no sleepless nights. It's basically a liquid safety net that earns a steady return. And that brings me to my one big lesson. Over time, I realized that I didn't need a complicated mix of funds and bonds to achieve balance. At my stage of life, a simple two-asset class setup, equities and CPF-OA, already does the job beautifully. Morgan Housel put it nicely in a recent interview. Buying equities is basically buying into capitalism itself. It's our way of sharing in the growth of businesses all over the world without having to run one ourselves. Cash or CPF-OA, on the other hand, plays a quiet but equally important role. From a modern portfolio theory perspective, cash has close to zero correlation with equities. In real life, that means that when market crash, cash is king. It's dry powder, a psychological anchor, and a safety buffer all at once. That combination might not look textbook perfect, but it does exactly what the MPT or modern portfolio theory promised. It balances risk and return. Only difference, it does it in a way that fits the local context, my own temperament, and my life stage. And when you look at investing through the aging lens, simplicity starts to matter for a completely different reason. It isn't just about convenience, it's essential, especially as we head into the later phases of our lives. At some point, a spouse, a child, or even a caregiver might have to step in. If we leave behind 12 asset classes and 10 different rebalancing rules, that complexity might backfire. A two-asset class setup, equities for growth, CPF-OA and cash for stability, is easy to explain, easy to monitor, and easy to pass on. I haven't abandoned the modern portfolio theory, I've just simplified and adapted it. I used to think harnessing MPT meant adding more products, more moving parts. Now I think it means keeping fewer asset classes and staying humble enough to know that simple can be more than good enough. For me, it's a global equity fund on one side and CPF-OA on the other, a balance between peace of mind and enough return to live the life that my wife and I want. I like to joke that I've reached my own efficient frontier of effort, minimum work, maximum quality of life. At this stage, I don't need to squeeze an extra half a percentage point of return. I just need to make sure that the assets we already have translate into freedom, flexibility, and the time to enjoy what really matters. So what about you? If you could only keep two buckets in your retirement plan, what would they be? Drop your thoughts in the comments below. If you found this helpful, give it a thumbs up, share, and subscribe. And till the next time, remember, sometimes the best form of aging is just aging normally. See you in the next one.